It's time to spotlight gold, silver, and oil in 2026. Joining us to help us do that, David McAlvany, the CEO of McAlvany Financial Companies. David, great to see you. Happy New Year. I haven't seen you yet in 2026. Let's talk about gold. You've got us on another record day here for the metals. You've also got a really advantageous three-year target, $8,000 an ounce. That's pretty high, above consensus. What's the core driver behind that call?
And so driving the market for several years and getting us largely to the prices that we have today is price insensitive buying from central banks. Investor demand has been strong in the last 6 weeks, but not the last 6 months or 2 years. So I think there's a lot of room for the metals, both gold and silver, to move on the basis of investor demand. And we have yet to see the safe haven aspects of gold reached for, in large part because the stock market has held up. We're near all-time highs, and there's been no reason for people to change tack on tech and AI and the winning trades of the last several years. So I think it's very expensive, and it's very under-owned. The adoption cycle for investors is just beginning.
And so we have seen this really aggressive buying from central banks, like you just pointed out, signaling de-dollarization in some ways. It's the first time in decades that we've seen central banks actually holding more gold by value than U.S. Treasuries. Why is that milestone so important for markets?
Yeah, I think it's not only now central banks, but also institutions who are looking at escalating geopolitical risk, very dysfunctional monetary and fiscal policy, and they're looking for a hedge. So you've got the folks who are front running the headlines, and then I think you'll have investors step in as they respond to headlines. So that's again sort of the second leg higher for the metals. But clearly, central banks are uncomfortable with what we did dating back to 2022, when the U.S. Treasury seized $300 billion, which is roughly half of Russian currency reserves. And you saw a marked change. We went from 300 to 500 tons per year consumption by central banks to now consistently about 1,000 tons a year, roughly a third of new mine supply going to central banks. So you're talking about a relatively small market. We could talk about really small markets in terms of silver, but that's one of the reasons why there's not a lot of room for investors to squeeze in without the price moving higher and even on an exponential basis.
All right, we'll get to silver in just a second, but I want to stay with gold for a moment. I know you favor physical gold for safety, but you also mentioned that you see some upside in mining. How should investors think about balancing protection versus speculation, and also at these, as you pointed out, extremely elevated prices?
Yeah, as asset allocators are looking at the metals, they need to be clear on what their mandates are. And if it is insurance or safe haven, then I think physical metals fit that bill, because you're dealing with a financial asset that doesn't have financial counterparties. And that's very, very critical. If you're looking for fun and profits, if you're looking to speculate on the operating leverage implicit to a precious metals miner, then I think you can build a position in top quality mining companies. Probably one of the most important things you can do is focus on jurisdiction, tier one jurisdictions only. I don't care if somebody has a great production profile. You have to now be aware of resource nationalism, confiscation of mines, to the degree that Trump has sort of demonstrated and led, state power being on display. I think you can expect to see the same thing the world over as people act on a very self-interested basis, as administrations and bureaucrats say, hey, wait a minute, this is our natural resource and we want it back. So be clear, if you're going to play in the mining space, tier one jurisdictions, this is North America, Canada, really limit the scope. And that may limit some of your upside gains, but you're also cutting back on some of the risks which are unbound.
All right, so let's move to silver now. You call silver's moves what you call a generational repricing after we saw pretty much decades where we were capped near right around $50. What structurally changed in terms of silver to move prices higher and extend this record-breaking rally we're seeing?
Yeah, well, I think 92 would have been considered an absurd number at the beginning of last year. We're trading at $40, and nobody really had the imagination for 100. I think the imagination is still lacking in terms of where the price of silver goes. But we've been in a 5-year supply deficit. So that's one factor just in terms of supply and demand dynamics. We talked about the demand dynamics.
All right, David, we appreciate you being with us to talk commodities this morning. Always appreciate your insight. That's David McAlvany, CEO of McAlvany Financial Companies.